Testing, one, two. Hello, my name is Troy White, portfolio manager with Hoodoo Financial, and today we're going to discuss portfolio building. And basically, I want to discuss how to build an investment portfolio to achieve your goals. And the thing is, uh, when I work with clients, we work within three specific arenas, and that's stock market, um, the real estate market, and entrepreneurship. So that's some individual business or side hustle, so to say, that we have. So considering those three things are the methods to build wealth, the stock market, real estate, and business ownership. When I say an investment portfolio, I do include all three of those categories: stock market, real estate, and entrepreneurship, meaning a business, some sort of business startup. So, how do you build a portfolio that includes those things? And don't those things compete with each other? And because I need startup money, I need to invest, I need to create a down payment. How do I do that? How does that all work together? Those are some of the questions that we're going to kick around right now. And I have no definite pathway for the conversation, but we're going to dive into it. We just started with a couple of those. And I'm going to utilize the whiteboard a little more often, and that helps me get my thoughts together as well. So we're talking about uh, real estate, a stock market, and I'm going to just call it business ownership, which obviously stems from entrepreneurism of some sort, and or some expertise you have, some sort of way of investing, right? Of starting this business. We can talk all day on that, but understand when I'm talking about it, I mean you're going to be doing something. Part of the portfolio to get you from where you are now to the category of wealthy or rich or whatever it is in your goal, that dollar figure equals, is going to require you to do something that turns $1 into $1.50, and that's entrepreneurship, a business. If you can do that on a consistent basis, we call that a business. So, of those three categories: real estate, stock market, and business ownership, and in terms of building a portfolio, the type of portfolio we are talking about exists with it. So we're talking about uh, portfolio, and that portfolio exists because you are. Let me stay out the way of that big white that light spot. Because you are legacy investing. Legacy investing. Now, just as a recap, what is legacy investing? It's it's the opposite of just investing for the limited time horizon of your lifespan, and that's how the financial services industry is currently set up to serve you for as a regular regular person off the street that doesn't have more than $500,000 in investable assets. Then you're not going to be advised in such a way as to invest for your legacy. You're only going to be advised to invest for right now. And there's many reasons why: social, economic, business reasons why it's not practical to, and also the client don't want you to. You don't want that. So because it means advising you in a different way. So we don't have to beat up on the company and say, oh, it's racism or it's this ism or that ism. It just is, it is what's happening right now. You're so if you come in with twos and fews, just a few dollars to invest, meaning a few dollars means anything less than $500,000, then you're going to be advised in a different way. And that way is not legacy investing. That way is something called uh, in, in the industry, the professionals who have to study and understand what we're talking about. The category is called life cycle phase investing. That's what you're doing, but you don't know that's what you're doing. So your life is a cycle of our lives, and our lives go through phases, and therefore the financial services industry is set up to serve you through those phases of your life, and they're trying their best to do an admirable job at doing that, but it's not taking into account various socioeconomic factors and historical factors and history itself and history repeating itself and goals of certain ethnic groups and other sectors of the American society. And if you consider those things, then you shouldn't advise people to invest in that life cycle phase form of investing. Should many of you or many of us should only be legacy investing. And the a legacy investor and a life cycle phase investor may be investing in the same thing. So it's not necessarily that you wouldn't purchase a certain type of stock. It's just that your whole frame of the whole track that you on, that your train is on, has to be different, has to be built different. It has to be ready to carry things in a different way. It's got to be ready to get to make some stops and starts and do some different type of lifting and heavy lifting, and and then taking into account that you don't have the resources to do some things. So we have to kill two birds with one stone, but also we need to kill more than two birds. Sometimes we need to kill three and four birds with one stone. So that's what legacy investing is all about in layman's terms. When the rubber hits the road, the nitty gritty it boils down to working individually, one on one with the client to help get you to understand and recognize and realize the methods and the processes and the products that you should be engaged with in your investing life and what that's going to do for your legacy. Read the word. The word is legacy for those who come after you. So it's a legacy is the sequence of events that occur after some action took place in the at a previous time. So because you laid this foundation, the legacy of that is people get to walk on this foundation. So you stretch that out and understand where I'm coming from. So we talking about building an investment portfolio to achieve your goals. And so how do we build these? All right, this is going to be the hardest one in terms of building a portfolio. It's going to be the hardest one. It's easy for me to think of ways right now that we can build a portfolio, but we need to address, do we even want a portfolio of businesses? Do you want a portfolio of businesses that you are personally engaged with the owner of, or is it just one business, some entrepreneurial endeavor that is going to be a part of your overall portfolio of assets? All right, stock market, I can knock that one out real quick. Fundamentally, you need your stock market portfolio is it's all about diversification, right? What's diversification? That's putting your eggs in more than one basket. You don't want all your eggs in one basket because that basket falls, then all your eggs is smashed. So, and that's very easy to understand. But so diversification is, if in that same scenario, if we had a lineup, and in fact, not even a line, we had 100 baskets of eggs, all at different locations. So if this building was to smash, and this basket was to break, those eggs are gone. But we got eggs in New York, we got eggs in LA, we got eggs in Seattle, we got eggs in Chicago, so on and so forth. So that's the diversification. That's spreading the risk, making sure that if it goes bad over here, I have an exit point. That means somebody got my back over here. So in terms of the investor world, diversification is one of the most important factors, because from the analysis standpoint, the diversification, we're going to line that up with your risk tolerance. Risk tolerance tells is basically all about how much how much risk you could tolerate. And the funny thing is, as your knowledge increases about investing in the stock market, your risk tolerance increases. It's just the more you know, the more comfortable you feel, the more risk you're willing to take. And it's funny to me that, I have some acquaintances, friends, people I grew up with. They might be at a dice game, out on the street at the playground. And a dice game is a fascinating activity to me. I'm watching it just like as if I'm watching the traders on the floor of the stock exchange, and it's an activity that's happening. It's hard to keep up with, and you need to know the terminology. You need to understand what investment has just been made, because the market is flowing at all times, but then so are the bets, so are the meaning the investments are flowing. The game doesn't stop. Stock market doesn't stop just like that. So your point is 9 with this guy over here, your point is 8 with this guy over here. He just rolled a 6. You got to know what's happening. We're looking out for the 7s, and then somebody else want to make a bet. It's very complex, but my point there is that the person may have a that understands that game. So I stay on the sideline because I can understand it theoretically, but I'm uncomfortable. I can't get in there. I can't get in and play. Maybe a side bet at most, but I can't be on dice. And that's because I'm uncomfortable with it. I don't have that knowledge, that understanding of that game. So my risk tolerance is low. I can't tolerate that. I feel that I'm gonna lose my money. So I just keep my money in my pocket. And so most people are that same way with the stock market. They feel that, it's like, I don't even know what I'm looking at. People see a stock symbol, they don't know this is Apple and Disney and Google and all of this. They just see a bunch of numbers and letters and stuff, and it looks just like mass confusion. So they get the same feeling. I'll just keep my money in my pocket. Then it's too much of a gamble for them. So but as you understand what you're looking at, your risk tolerance goes up. Your willingness to play increases. Same with folks on the street in that analogy that I was making. So, risk tolerance and the level of diversification combine together to help create your portfolio, because we're building a portfolio that has what's called a beta to match your risk tolerance. We want, it's these different key terms that you'll never have to concern yourself with. Only the analysts have to do that. So the beta, the standard deviation, and this how far away from the benchmark we're willing to go. We talking about stock market here on this. So how much risk can you tolerate away from the standard? And so that means you should at least be getting the standard. So And again, you need someone who's going to guide you through. So you just met one. If you are in earshot of this video, then you can contact me, send me an email, and you can be one of my clients. But point being is that if you don't have someone to help walk you through, to consult you, advise you, then you just be like, I just keep my money in my pocket. So come to us. Well, what I recommend is we build for our clients how we build their stock market portfolio. Is it we don't have investment minimums. It doesn't matter if you invest in $100 or $1 million a month, as long as you invest in. And so we select the portfolio again based on various criteria that fit your personal financial circumstance, but your risk tolerance and your goals. And so we devise the portfolio may consist of, let's say, 100 stocks or less, right? So let's just call it 50 different stocks that we feel this portfolio, if you invest in this one every month, you're going to reach those goals that you said you have for yourself. And I know some goals that you should be thinking about, and I'm going to direct you toward to put those on your mind. And then I'm going to I'm going to help achieve the goals you're not even consciously thinking about, just things you might nonchalantly want to achieve, but haven't put a plan in place to achieve it. Well, I'm going to uncover what those are, and I'm going to put the plan in place. So that's what we build portfolios to accomplish. And so we pick the portfolio, and you invest your $100 a month, your $1,000 a month, your $1,000,000 a month, whatever you have, whatever your resources allow. You invest that every month. And since at our firm, our clients have the ability to invest in fractional shares. So as I build your portfolio, you are investing in fractional shares of those 50 stocks. So you invest $100 a month, you're getting all 50 of those stocks in your portfolio, $100 worth at the various weight of those 50 stocks that we selected for your portfolio in fractional shares, bam, every month. So you build that up for now till forever and on to fitting into your financial plan. So that's how we build the stock market portfolio. So if you don't have access to fractional shares, then even if you do, it's still you're not working with a money manager. So I'm a portfolio manager, so I can build that portfolio to start with. But you can pick one stock at a time and do it like that. If you're a go it alone type of person. But otherwise, the short answer is get an investment advisor and get started on building a portfolio. So you need to do a financial plan first. All right, real estate. How do you build? This is the one people really want to hear about all the time. How do you build a real estate portfolio? So you build a real estate portfolio by doing three things. As a real estate investor, um, everything revolves around very fundamental practice of, and I'm just going to list some of the words and they all connect together. So you are going to have to do wholesaling. I'm assuming you have no money or experience right now. And if you do, the more the merrier, but these are still some of the things you're going to do. Wholesale, you're going to fix and flip, and you're going to buy and hold. Now, the same activities to accomplish this one is the same activities you're going to use to accomplish that one. The same activities you use to accomplish that one are the same activities needed to accomplish that one. Now, we're going to get to that too. So how do I do that? You need to find um, investors, you need a list of them. You need to build up a listing of them, of investors. So you need buyers, those are buyers. But you also need sellers. Some sellers are fixing and flipping, and they'll flip it to you as to buy and hold people. So, so those investors could be sellers as well. And then, and the sellers you're going to uncover by using. There's so many tools I can't even cover right now in this one, but I have an online investment program called 40 Units and a Mule, and the tools come with the program. So it's about training you to become a real estate investor, starting your own real estate investment company. And those tools are a lot of digital tools, basically to uncover people who are in various circumstances that need to unload properties quickly, or are at least willing to unload properties for a discount, because there's a formula, there's something that you need to know about, something called the ARV, and that's the after repair value. And then there's something else, the market value. And these are in relation to real estate. And when you do the analysis, to be able to do any of those, you're going to need to know what these things are. So you need to know that after repair value, that's the value of a property after I fix it up. This is your dream almost, right? So, but it's not really a dream. You have to do a realistic assessment of, hey, this house on A Street sells for 100,000 right now. So market value currently is 100,000, but it's raggedy, it's missing this, it needs that. If I do this, if I do that, if I put sweat equity in it, paint it and stuff, it'll be worth 150. That's the after repair value. And then there's something you need to know called the LTV. That's the loan to value. All right, because I'm gonna give you this formula, and then we're gonna wind it up and shut it down. All right, and because in order to wholesale, you're gonna need to know this formula, and the formula is 0.70 times MV. This formula, sometimes people use ARV right here. So that's what I'm going to talk to you about that in a second. Times MV minus RC. RC is repair cost minus uh, SC, sales cost. You can put holding costs, um, but let's just call it sales cost equals your purchase price. So it's a house for sale, 100,000. It's worth 100,000 right now. I tell that person, hey yo, I'll give you 70%. That's how you tell a percentage. If you don't know your math, 0.70 times the number is 70% of that number. So that number we said was 100,000. So that means I'll give you 70,000, right? But lo and behold, the roof need repaired. Oh, that's 5,000 minus that 5,000 then. I'll give you 70,000 minus 5,000, so that's 65. Oh, plus it's going to cost me 5 G's just to, paperwork shuffle and, inspection and all of this here. So let's pull another 5 G's off. That's 60. So the purchase price for this $100,000 property is 65,000. Now, if you were on a mission that's always out there looking for people in a scenario who will agree to this formula, then you can sell that. Let's say you find it, so it comes down to the person say, okay, give me 65,000 then, give it to me right now, right? And that number increased. If you said this was $1,000,000, then now he's willing to accept $650,000. Okay, they say give me the 650. All right, and now you're gonna say to me, but well, I done convinced this person to sell me the house for $650,000. I don't have $650,000. That's why we did this formula, because I know you don't have $650,000. Remember this right here? So first off, he tell me he'll give it to me for $650,000. I know that an investor will probably plug this number in right here. So it was worth 100 in the first place, 100,000. But the after repair value is 150,000. So he gonna plug in 150 and do this, and that's his price. So your price, your money comes between what's here and there. So you basically charging a fee to sell him that. So your job is out there finding people who are willing to sell under this formula and people who are willing to buy and pay for this deal that you just got. You got the person to give you under contract. Say, okay, I'll sell it to you for $650. So you're gonna go sell him the deal. You're gonna sell him the deal. You might sell him a deal for 650,000 on a 1 million. That means he's gonna get the equity right away. You might charge that for $50,000 for that deal, or or less or more. So that's what wholesaling. You're selling this whole transaction. Now, that whole transaction, if you let's say you uncovered 6 of those this week, and you can only unload 2 or 3 of them, or 5 of them. All right, keep one for yourself. You fix it and flip it. Again, you saying, but T. Roy, I don't have $650,000. I know you don't have $650,000. That's where 100% financing comes in. Because first of all, there's no such a thing as 100% financing. What business would give you 100% of any deal that's market rate deal? If that was the case, if they could make money doing that, they would just go around doing it themselves. No. But if you did this, they will give you 100% of this, but this is 70% or less of this, the market value of the V. So 100% financing of this deal of which you are already giving the person 70%, because they're going to give you 70% loan to value. So the value of the property, they're going to give you a loan that's worth 70% of the value. That's where these all come into play at. So then they're going to give you 70% LTV to acquire the property, and then this way is just trust me that you can work work a twist on getting the repair expenses as well. But if you bought the deal where they pulled out, that's less than 70. So if they give you 70%, you've already bought it for less than, and the person agreed to this, because the person might sell to you will not agree to this, but they might agree to that. They might agree to both, or they might agree to a price that's just that. So if you already got that discount, then that's even gravy. But it's possible that you might have to use credit cards or something to do the repair costs, to come up with the supplies and whatnot, the materials. But that's how you would fix the property. But then flipping it is where the sales costs come in, because flipping it is when you sell it to um, to you sell it in the market. So you're gonna need a realtor. But let's say hypothetically you flipped it to yourself so that you can buy it. You bought and you held it. So you tried to wholesale the deal. You wholesale. You sold 5 of the 6 deals that you came across. Kept one for yourself. You fixed it with the proceeds that matter of fact, that's where you got the money from those other 5. The money you made off of those. Well, you just put 20, 30,000 into this property, and now you're ready to sell it. So now you sell it. You don't get this lower price that you've already got 30% equity, right? So the 100,000, you already bought it with $30,000 coming back to you when you sell it. But you increased the value as well. So now you're talking the ARV. So when you sell it, when you flip it, it's at the ARV. So if you injected the value, you moved it from 100,000 market value to, let's not go overboard. Let's just say 20,000, 120,000 now in value in the market. Well, you bought it for 30% less than it's worth. You made it worth 30%, 20% more than it's worth. So that's 50,000 right there that goes to your pocket. So let's say you're holding it, and then that's how you build your portfolio, because you use this process and you build up your money by fixing and flipping. But sometimes you flip it to yourself, meaning you refinance this whole thing at this higher ARV. You refinance this whole thing to yourself. So now you're holding it and just collecting rents on it. And that difference between what you bought it for, that 50, and what it's worth now, because you injected value, that after repair values, that's 50,000. We in that scenario we were talking about. Well, what if you got a home equity line of credit? That means you can tap that equity, that 50,000 at any time. Now you're going to start to see where the magic comes. Now you got 50K in equity and the HELOC, that's home equity line of credit. And so that 50K, you bought and you're holding it. Let's say, and so it's making some sort of rental income. So rental income. So what do you do with that income? You know, first off, get out of the mindset mode that, oh, I'm gonna spend it. I'm gonna get a more expensive car. I'm gonna buy bigger lunches. I'm gonna buy more shoes. I'm gonna buy more jackets. No. I'm gonna buy bigger, more gold, more diamonds. No. We're buying um, asset assets that increase in value or generate income. That's balling. So we buy and hold it. So now we got we we've injected 50K worth of equity into this property for yourself, and it's in the form of a HELOC. And now it's creating rental income. Let's call it $200 a month, $500 a month, 1,000, whatever it is. What do we do with that money? It goes over here, building up your stock market portfolio. So as your stock market portfolio grows, we're still doing this thing right here. We're trying to make money via wholesaling some of these. We find more of these deals across America. We find five, sell four, fix and flip one. Keep doing that, and every now and then fix and flip one to yourself. Now you're buying and holding it. And if you've done this formula, then you've injected equity. With that equity, you can get another HELOC. With that, the equity in that property that you buy and holding is currently being rented. It's currently generating rental income. What do I do with that income? I'll put it over here again. And so then that means now I got two of these. Give two with equity in the HELOC, giving me a stream of rental income. Then, and it's building up my stock market portfolio. This activity in itself is a business. So my entrepreneurship aspect of my portfolio is already satisfied, but we can get into doing other businesses on the side as well. But as you see, this right here, you just rinse and repeat, and you do this over and over and over and over. You don't have to do it with the anxiousness. Just do it steadily. Just steadily be in search of investors, meaning buyers and sellers, and in search of people in circumstances that you can uncover deals using this formula, because this allows you to add value to the market value. You purchased it under the market value. You refinanced it at a LTV that allows you to get 100% financing of the entire deal. And when you do that, you're going to be making money as you wholesale these properties. You're going to be fixing and flipping, making more money than you would when you wholesale it, bigger, fatter chunks. Of some of those fix and flips, you're going to keep for your own real estate portfolio. Your real estate portfolio is about buying and holding. You're not going to live in all of these. You're going to rent these. As you rent these, they're making rental income. But the physical building, you're going to have injected equity by using this process right here. And you're going to use that equity in the form of a HELOC. As you right here, we say you got two now. You're just going to use this HELOC over and over and over and over to do this right here. Buy more properties to fix and flip. And then you're going to be taking your pick as to which ones you buy and hold. So you're going to be flipping them, dumping them off, keeping some. The ones you keep continue to generate you a rental income that helps you build up your stock market portfolio. The ones that you keep, as the equity grows, we let the HELOC grow. As the HELOC grows, we use the money in the HELOC to acquire more of the properties that we found under this scenario. Because under this scenario, we can have HELOCs in it. We have equity injected, built into the deal. And so that's why it allows us to use our HELOCs to grab some more of them. As we grab some more of them, that's our buy and hold strategy, which is building your portfolio, which is making you money, which got you having you access to more and more money at all times. So you can buy more and more of them and keep it growing, keep it going. Bam, 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 bam. It's a formula, it's a process. Once you get it underway, it's going. It don't stop. That means your everyday actions is going to be looking towards just nonchalantly finding the deals, and just on the slow path of just doing one a year. If you did this to the point, if you did this whole process, if you did one of these a year, one wholesale deal a year, one fix and flip a year, and one buy and hold a year, you'd be off the Richter. But if you even just did one, I encourage you to just do this one. If you can just buy and hold one property, especially if you get it under this circumstance right here, if you can buy and hold one a year, that's legacy investing. Then you have something to pass on. All right, that's enough talk. Thanks for listening. That's how to build an investment portfolio that's going to help you achieve your goals with real estate, stock market, entrepreneurism. Thanks for listening. Holla.